If it was maybe double that size wick, then yeah, I would have some issues, because that would let me know the market really tried to push itself a lot higher yesterday, couldn't do it, and started coming back down. Now, with what's happening today, that does lend more credibility to that possibly being that Japanese candlestick. But just from yesterday's action, I'd need that wick a little bit longer before I really started to put some effort and belief behind it.
Yeah, no, that's a good point there, Jeffrey. When I just look back at the chart, you could say, hey, was this also, gravestone? Now, this isn't at a new high. You see some of those similar patterns where it's opening, rallying up, and then closing where it opened. So you're not too alarmed at this point. Maybe this provides a little more credence. Is 10,000 mean anything to you, or is it just kind of one of those round numbers that?
No, absolutely. It definitely means something. It's one of those psychological numbers, just like for the S&P at 3,000. That's something that really crosses our mind. Dow Jones Industrial Average at 25,000 definitely plays into it. If we, let's say, over the next week go below that 10,000 line on the NASDAQ, then and stay there, then I'm saying, okay, now we're starting to settle in a little bit more to the reality of what's happening in the market. If we pump past that previous high in February, I would be getting a lot more bearish and a lot quicker than I did after we had that initial pop up from our March 23rd low. What are your thoughts, my friend?
Yeah, no, that's it's so. This really isn't an easy market to navigate. I mean, we use technicals and they definitely can help, but we really have this unique situation where the market's just in one of those modes. It really does remind me most closely to kind of the price action we saw in the late 90s. And I know people have mentioned that before. It's not this economy, totally different dynamics. But the reason that polarity, I think, is just because you'd come in and you see the market higher, you see the price target increases, you see the market higher, you'd see bad news, you'd be talk of overvaluation, the market moves higher. It was just a persistent move higher. And we have seen the speculators come in. We have seen some of that speculative call buying activity. That makes me a little bit worried, but it's just the timing about when you don't really know when we're going to get one of those whooshes, those profit-taking whooshes. And we saw one for about 7% or so, what was that, 2 weeks ago? After the FOMC meeting. But yeah, I think you want to be cautious. So this leads me into the other question, Jeffrey. So, I think it's probably a little bit clear on the Dow, but what do you think about this being called an island top for both the Dow?
Yeah, I think that's a good call. That this one looks a little bit more like it had its legs and now it's getting tired. And Liz Ann Saunders, our chief investment strategist, talked about this now looking more like rolling W's or rolling M's, depending on which way you want to call it. But seeing the Dow, it almost appears to me to be a little bit more in line with reality, as opposed to the tech-heavy NASDAQ, where you've got Apple and Microsoft at over 40% of that thing really pushing the market. The Dow seems to be taking into account more so the forward PEs, which are in excess of 25 in a lot of cases. And that's something to be a little bit concerned about, especially as you have more unemployment still in the market. I mean, we are still because we see the Fed and the government pumping money into the market. We're like, okay, I think for me, one of the things I'm looking for that might break us down, either on the NASDAQ or on the Dow, would be something coming out from either the Fed or from our Congress saying we're no longer going to pump money into the market. Because that, I think, is what has driven us, with 2/3 of our economy coming by way of consumer spending. Well, if you're not just giving people money, they don't have any money to spend. That's going to really dry things up pretty quickly. So it'll be thought-provoking to see what they do as we get closer to that July deadline. So those are some of the things that I'm keeping top of mind. But yeah, with the Dow, it seems to be taking into consideration a little bit more of the reality of our current situation as opposed or compared to the NASDAQ.
Yeah, no, those are good points. And yeah, I got to say, just overall, Jeffrey, I know I've mentioned that, a couple times over this past 3-month rally that we've seen. I'm like, just something doesn't quite feel right. That it seems like I want to be bullish on the economy. I want things to get better, but then for example today, and this isn't contributing to the weakness that we have. So I think that it's really been, the COVID upticks we've seen, mainly in some of these southern states that you and I are in. The IMF, though, downgraded their forecast for global growth, now seeing 4.9% down this year from a prior forecast of down 3% in April. For 2021, they dropped it they do see a rebound next year to 5.4%, but that's also 0.4 lower than that. So I feel like the narrative for this rally has been, well, yes, we're seeing incremental increases in reopenings. We're getting the Fed, that's the biggest one. The Fed, really has our back, and the economy is going to get better. And so it seems to me that in order for that narrative to really hold its weight, that you're going to need to see some of these numbers move higher. And what we have, or what the market's actually finally reacting to, it seems like, is that, hey, the IMF's coming out and downgrading global growth. And by the way, for the U.S., they dropped GDP to a -8 from a prior forecast of -5.9. You get the COVID flare-up. If it gets bad enough, I know they said they won't close down the economy, but that doesn't mean it's not a possibility. So it seems like some of these waves are moving in the wrong direction that would continue to support the thesis that we can just push this market higher. What do you think?
Yeah, I agree. And if you think about it, as our viewers probably already know, this is very, very much driven by COVID news and what comes out. As you see that top that Nate has, that rec, sort of the point at which people started thinking maybe they're going to close back down the economies. And I've already seen that Europe is not going to allow certain people coming into America unless they do a quarantine for 2 weeks. I know that California is once again mandating that everybody wear masks. You've got what's happening in Arizona and other places like New York and New Jersey, and I think Pennsylvania said they're not going to allow flights coming from Arizona or Florida and a few other states. So now, that, just like how the Dow is starting to pull back, it's almost like the economy is starting to shrink back up a little bit as people start to worry, are they going to continue with the phased rollouts, or are they going to pause for a little while? And I think the market's doing a wonderful job of reflecting that mass psychology.
Yeah. At least, I feel like today, you're right. I think that it's being rational in the sense that it is trading down roughly 2% in reaction to that. So I think that, you could say on the plus side that seems to be sane at the moment. And so the other thing that I wanted to just throw in there, I forgot, was just, potential tariffs on the EU. And, if that trade war, we don't need another we don't need another monkey wrench in the equation.
No, we don't.
We're already
2020's had enough, man. You're right.
Yeah, I know. So that's another thing to keep an eye on. I'm cautious here. I think just over the next, normally, I think historically we'll see that volatility when late August, September, October, around that time frame is when those are some of the worst performing months. You can see that volatility flare up. We could see some of that earlier. I don't know. It's just, I say be on the lookout for more volatility, and we could talk about some things that you might do, some strategies you might do if you're concerned about a potential downdraft in the market. Lastly, I'll just say here, Jeffrey, that Randall was asking about that this red candle today. I mean, it looks like it's improving, but earlier in the day, perhaps it was looking like a bearish engulfing candle from 2 days ago. Is that any significance to you, or is that just, do you kind of sign it off because that was 2 days ago on that that would then be significant?
I take note of it, but I would have put more importance on it if it swallowed up today and the previous 2 days. If it swallowed up yesterday and the 2 previous trading days, that I would really say, okay, this is something to watch out for. It's gobbled up not only the past 2, we would say the past 3 trading days. That would very much be on my mind, but because we topped ourselves out, went a little bit higher, tried to go more, and then couldn't, I'm not as concerned about the bullish engulfing effect. Now, that doesn't mean to say that tomorrow we're not going to be down again. I could very easily see us going to that, what is that, your simple moving average, and just finding ourselves there like we did back in mid-June. So to look at a bearish engulfing, to the audience question, yes, there is some credibility to that, but I would have liked it a little bit more if it would have taken out yesterday's movements as well.
Great. Okay. Thanks for that context, sir. Yeah, so continue. I think, when I've had you on in the past, Jeffrey, I'm just nimble, take the data in day by day. The price action still is bullish. We're still definitely in an uptrend, NASDAQ all-time highs. If I look at something like the S&P or something, what would stick out to me, Jeffrey, is just, if I keep it simple, I would say something like, okay, there's your resistance, and then we'll call the 200-day, where Big found some support ish 2 weeks ago. Does that sound pretty reasonable from a near-term perspective on the S&P?
Yeah, absolutely. I think now is probably a decent time if you haven't already. I know we've got shows about this, but at bearish spreads, take a look at bullish spreads, because as the market gets more range bound, as it has been the last couple weeks, that's a really great time if you're looking to trade options to start doing some of that neutral trading, if you will, by way of the two support lines that Nate pointed out, the top one right there, and then also the bottom ones, which happens to correlate nicely with that 200-day simple moving average. So I think I'm on the same page as you are, Nate. To give a strategy to that, take a look for our audience at bearish and bullish spreads on either side of those lines.
Great. All right. Thank you. So Tech is asking, with the COVID, it's still kind of looming, and some of the science and medical data indicating there may be another second wave, coupled with the seasonal flu in the fall and the winter. Will there be a probability of a downturn as we saw on March 23rd? Jeffrey, I'll comment first, and I'll just say, well, Tech, I feel like that this downdraft that we had, this first initial downdraft, really caught us off guard. And to get that big of a surprise and to get the fear really escalated that high, keep in mind the VIX went up into the 80s when we got down here. So I do not see something that big happening now that the market has already really introduced into the narrative and into the psyche that really supports that the Fed is going to be there no matter what. The Fed has communicated that. The Fed has also communicated, though, that they're concerned about the economic data. They have not been rosy about the situation. They see the potential for a prolonged impact to the economy is what Chairman Powell has been communicating. Do I think that we could correct 10, 20%, something like that, if we do get this second wave, and if there's a lot of concern about these businesses and those types of situations? Sure. I think that there's going to be a volatile second half of the year. And then we've got the elections, and Jeffrey, we didn't even note this, but with Biden, which is seen as, not a market-friendly president, potentially going into that role, that's going to create some more volatility and concern over corporate profits, et cetera, corporate tax rates. So yeah, I don't know, Jeffrey, what do you think if we do continue to see this uptick in coronavirus? What are your thoughts about the market? How low could it go? Or
well, one of the things that I've been paying attention to, Nate, because as you know, I'm an avid Wall Street Journal reader. They talk about the number of cases in the U.S. and around the world. And I've been looking at that, and of course, cases keep going higher and higher and higher. But I also recall a book that came out, I think in the 1940s or 50s, called How to Lie with Statistics. And if you're just looking at one component, one piece of the pie, you're not getting the entire picture. So what I've done is, instead of looking at the number of cases, which are inevitably going to continue going up, just the way it works, you can't undo a COVID case. What I'm paying attention to instead is the deaths that are attributed to COVID. And if you look at that on a 3-day moving average, that continues to decline. So even though we have opened the economy back up, even though there are more cases, the number of deaths continues to decline. And it's not as though they've found a better treatment for it or some facility that's got some sort of magical cure. It's just that people aren't getting it as much to the same degree that they thought they would as we started to open back up. So I think that's a positive for the market overall and lends to the credibility of continuing to either open up, not advance to another phase or retreat back from where we were. And then to your point about the elections, that one is always a big what if. That could be a big, huge asterisk when it comes to that. I know for us as options traders, those juicy premiums in November are going to be a wonderful experience to entertain. But ultimately, I think happens more in line with the coronavirus, and then as we shift from that, like you said, that September-October timeframe, then our focus might start to go a little bit more to the elections. But right now, when I talk to investors and I talk to some of my friends that are doing the managed investing, they're not really putting a whole lot of emphasis behind that because COVID is taking up such a large mind space.
Great. Yeah, really good points there. Thanks, Jeffrey. Doug's got a really good question, which I'm not sure if I have an answer to, but he says, how do I figure out the correct multiple to assign to a company or a sector for, what are your thoughts on assigning I don't know, correct, accurate, appropriate multiple, given what's going on right now with all the uncertainty?
Yeah, I mean, that's a really good question, Doug. So one of the things that I'm looking at and kind of focusing my attention on is I'm looking at the forward PE of an ETF that represents that sector. So if I'm looking at XLK, for example, with information technology, that right now has a price to earnings of 27, and I don't have the forward PE, but that's where my attention would be. How do these companies fall in line with something like an XLK? And I know you've got things like Tesla, and you've got Nikola now coming into the fray. You've got Shopify. All of those are just so far and ahead of what the forward PEs would be on a normal basis that is definitely capturing my attention. But to answer your question, Doug, that's how I would do it. Is I would say, what sector is this company in, and then find out what that forward PE for an ETF looks like.
Yeah, it's and it's, you know, Jeffrey, I think for XLK, that's probably going to provide your most reliable in terms of forward PE, prior PE, et cetera, just because those are the companies that have been able to provide that guidance and have clarity and have seen that demand. Some of the other sectors, you know, Doug, that does get really difficult to do. For example, if you were looking at something like within the travel or consumer discretionary or retail, et cetera, now that we've got this flare-up again, what does that translate into the reopening pathway? And that's where it gets difficult. And we've seen this conveyed in the companies that are not providing that guidance. So, yeah, you know, the analysts that we've seen are going to come out here and they'll provide generally an estimate, but with a really wide range. And so, the only thing I can say is that, you know, when there's that much uncertainty, just try to be, technicals can come into play, but just be a little bit more patient to where you're getting a price that you feel that you're being compensated due to that higher volatility in the range of the EPS in that. So you could look at something because the VIX is higher. If you're looking at a sector or a stock, you could say, all right, I don't know what this PE is going to be going forward. I understand the uncertainty in the environment. I know that the companies are saying that. But I do know that implied volatility is high. That's the reason. Well, maybe I can go out a month, 2 months, and look for a put strike that I feel I would be comfortable. I'm being compensated for the risk to get in, and then look at that premium and see if that's acceptable to you. That could be kind of a slightly defensive way to go about looking to get some entry into those sectors or companies.
Great insights, Nate.
Yeah, thank you, sir. Yeah, no, it's tough. I mean, we have the same questions, and you know, even the analysts, they're kind of compelled. Like if you watch CNBC, a lot of the analysts have to come out and say, "All right, well, okay, we see this, you know, coming in between the S&P earnings for this year are going to be anywhere from 100 to 150 bucks." Well, that's a pretty big range to deal with, you know. So, into some of the activity here, I'll just mention on the call side, Oracle again, once again, seeing some of that unusual call activity for the second day in a row. Yesterday, they were going after the 60 call in August and in July. And today, they were going after the July 2nd 56 call. Those are just calls, not too interesting. We've got some other strategies that I find more interesting to discuss because we don't get to talk about butterflies that often, Jeffrey. And then we've got a call print spread. So these are, let me just briefly go through some of the single leg kind of unusual activity. So Jeffrey, we had just on the put side, this appears to be bullish in nature though. So on this particular ETF, there were some multiple large, like 15,000, 2,500 contract blocks that were sold going out to November on the 55 strike, and these blocking anywhere from 215 to 227 for these puts going out to November. What are your thoughts on doing a put sale like this?
Well, so you're getting about 4% on that, and for the amount of volatility that we still have left to see going out until November, I'd like to get a little bit more. I'd actually probably want to get closer to 8 or 9%. So they must have some conviction that the moving average lines of the 20, the 50, and is that the 100? So they must have a pretty good amount of conviction that they put it as close as they did to those lines. I would like to see a little bit more. I know for my traders out there, you're looking for about 1% per month when you're selling something. And in this case, to have it not quite paying out as much money, I would be a little bit hesitant on that. But of course, I don't know what their thinking was, and they may have much more justification for their actions than I'm privy to. What about you?
Yeah. Good thoughts there. And you know, I think it's funny that, you know, so here's the thing that I think about is that, look, you know, if you're looking at this ETF, you're comfortable getting in below 55, you know, why not the September 3rd? For 50 cents less, you don't have to worry about the election risk.
Yeah.
Why not just go with the 55 strike in September? And then if you're really compelled, you know, here's the funny thing, Jeffrey, I know you know this, and we talk about this a lot, that when you're selling those covered calls or you're selling puts, generally speaking, if you go out in time to, let's say, the November expiration, 150 days, basically 6 months, that you're going to get a certain amount of premium. But if you were to do that same put sale 6 times in a row, that ultimately that premium would add up to more than the $2.15, 20, whatever, 27 cents that they received. So after you sell this put, if this particular ETF is above this strike, boom, you get all the premium. You can then reassess and decide, hey, I could sell another 55. Maybe at this point I have more clarity about the economy, and then I can sell, you know, whatever I want, or I choose not to do anything at all. So what do you think about selling nearer dated calls or puts, these income generation strategies, more often than just selling a 6-month or a 12-month put?
Well, personally, I think if you have the time that you can do that, then I'm a big fan of that because you're not risking so much into the future. And the best traders that I've worked with over my almost 11 years here with Schwab, all of them are using the short-dated expirations. So they're not going out on the leaps 2 years, 3 years in advance. They're going out maybe 1 month, and a lot of them are just doing weekly options on the S&P 500. But I've always told clients when we're in workshops and we're doing meetings, all other things being equal, just like you had said, Nate, the person who sells contracts close to the expiration or the shorter the expiration time, all other things being equal to that person will make more money than the person who does the longer. So if you did, just like Nate said, everybody, if I were to do a 1 month contract or I take four weekly contracts, again, all other things being equal, will make more money than the person who did the 1 month contract. It does take a little bit more time out of your week and out of your days, but if you have the ability to do that, I generally encourage that more than going out so far in time and leaving yourself exposed for all the things that can happen. And not to mention, great call out, Nate, the election coming in November.
Yeah. That's a good point. And then, but I feel like also, Jeffrey, that and thank you for covering that. But it's if you go and if you did, you know, the commissions on the ticket price are 0. We have 65 cents per contract on the option side. But if I go and sell a put 6 times over the next 6 months, at each expiration point, I feel like I'm going to have more clarity about the environment and what's going on, and you're never really, you know, locked into this put sale. So if I sell these 6 months at 55, you're right. I'm not locked into it by any means. But number one, Jeffrey, you know, like we were saying, you're generally going to receive more income if you do it 6 times in a row. But I just feel like you can just, you know, kind of reassess at the end of that first month and say, okay, how do I feel about it? And you can adjust your strike price. You could decide not. Maybe you become bullish when you were bearish. Now you're bearish and you used to be bullish, etc. And it just seems like a good, excuse to kind of check in and say, all right, how do I feel about this stock again?
Yeah, you're a little bit more nimble when you do the shorter time frames. Absolutely, Nate.
Yeah, for sure, for sure. Okay. Joel's asking about OIH, and Joel, this is exactly the ETF that we were going to bring up for that butterfly. So let's see what Joel is asking here. We are close to testing the lower. Does the option strategy seem to imply they believe the stock will end this gap by July 2nd? So Joel, I think, already read today's option market update. So let's go ahead and bring up exactly what this strategy is. It's a long buy strategy. Let me just zoom this in on the chart so it's a little bit easier to see. So July 2nd, we're talking about next Friday, and they selected the 120 put, the 110 put, and the 100 put. And I'll just go ahead and take some of these off so we can see this a little bit clearly. So Jeffrey, as you know, in this long call strategy, they're selling 2 times of the 110 put. They're buying the 100 put, and they're buying the 120 put. The total net debit on this long butterfly strategy is coming out for this particular block trader. And by the way, they did 4,000 contracts, 8,000 contracts, 4,000 contracts. The total debit came out to $1.80, which makes the break even. And if we go to our ticket, first, let me, Joel's kind of asking from a technical perspective. So, Jeffrey, let me get you to chime in. What do you think of OIH from a technical perspective?
Well, I could see that. You've got a bit of a topping at the we'll call it 113 level. Yeah, back to, see, it hit it at April 27th or so. Yeah, right there. So I see where they're going for on this one. That does make a lot of sense. They're anticipating it continuing to go down. You don't have a whole heck of a lot of support at where it is on this particular day, but you do see a lot more activity where Nate's highlighting that middle blue line. So I get their level of being. As far as the filling of a gap, I think is what Joel had mentioned. I'm not sure I see a gap down there, but I do see more activity. If we were to do kind of like a volume at price study on there, you might see a lot more volume happening at exactly where that line is. So as you can see, Nate's coming in here and bringing in the volume at price. And there we go. Okay, so yeah, there is more activity right there. There's much more activity down there at the 85.90 level. But yeah, so this might be a market technician that's given a lot of credibility to the volume at price for their particular strategy, whereas others might say, okay, I'm going to look more at the Ichimoku cloud or the Bollinger Bands, if you will.
Yeah, good points. And Jeffrey, I'm going to ask you, is this also look a little bit, I mean, we're not at a new high here, but is this also a little bit island top-ish here with this gap up, gap down? I know it coincided with the market, but is that significant to you?
In this trade, it's not. Okay, so if that's what our viewer is referring to, Joel, then that's a gap right there. Yeah, like you said, the island reversal. But for this particular trade, I don't know how that would have played into their line of thinking for next Friday's expiration happening at that 110. Any insights that I'm maybe missing, Nate?
Yeah, well, I think, now that I've widened the chart back out, it probably made it easier on you. I think Joel's referring to this gap here, that it came up and filled the gap and then essentially reversed course. Therefore, I guess assuming that it may be heading lower here in the near term, especially with today's candle. It looks like it's breaking that 20-day. That would be a little bit concerning to me if I was long this ETF.
Yeah. Hey, also on this one, great question out of Florida. What's the best way to put a stop loss in on an option trade? Now, I know you can do a stop if you'd like to, but that turns into a market order, which we generally don't like to do on options. But what if you were trading a spread? There is no stop order on a spread. How do you normally manage the loss limiting effect on something like that?
Yeah, it's a really good question because, Kevin, it's going to depend on the security. It's going to depend on the strategy. Are you dealing with 2 legs? And what I mean by that is if you look at a lot of the spreads that we've seen late February, OIH here, this is not that bad at 30 cents, 40 cents, but you go into some of these names, I've seen, we'll call it 10, 15, 20% spreads on some of these names. So it's really tough. Now, normally you would say, to Jeffrey's point, that you wouldn't want to use just a stop order that would just send out a market order. You would use a stop limit. The problem with that, though, is that you need to understand the timing of it. Like if we're in a stock, Jeffrey, you might go out there and say, okay, here's the 50-day. If it, I'll give it 1%, 2% below here. If it breaks that, then go ahead and get me out. And you don't really have to babysit that position too much. You've already said, I've defined my risk. Here's where I'm getting out. If you do it with an option position or a strategy, you have time decay that's working against that position. So while the security may not be doing exactly what you want, even if you set your stop limit or you set a conditional order that, I then close out of my position, but you could be a day before expiration. So with options, you certainly can set those stop limit orders in order to limit your loss. But I would recommend doing it either on a daily basis, especially in this market, daily basis, Kevin, really. So that's, it's a tough market environment to be setting up that type of an order because A, the spreads are wider because of higher volatility. We got a 34 VIX. And then B, because of you just got options being a derivative of the underlying with the time value that's working against that. So I don't really have an easy answer for you other than shorten your time frame and then make sure you use a stop limit to get you out of that. So why do I say stop limit? So you could say, well, if the bid on the option equals this, then you might say, get me out at this price. Because if it's moving down really quickly, then you're not going to want it. You don't want to just be at the mercy of the market makers. OIH actually 40-cent spread, 30-cent spread, not that bad. So that's why I say it also depends on the security. Take a look at how wide those spreads are. You might just need to kind of manage that position or set an alert that when the underlying hits a price level, set an alert so it lets you know that that's occurred, and then go to the option chain. Do something like that and manage your order that way. That's probably the best way to do it. It's just a really tough environment, Kevin, to be setting up that type of an order and forgetting about it.
Yeah, it's hard to automate right now. Really well said, Nate.
Yeah, it really is. Yeah. Okay. Another one we had here, call front spread. We don't get to talk about this that much. Okay, Cedar Fair. Jeffrey, let me ask you, Mr. CMT here, what do you think from a technical perspective?
I've seen better. If you're bullish, I've definitely seen better. It didn't take too much effort to get below that 100 period line. It also had a lot of pause at the 20 period, like I would have wanted to see. And now we're touching that 200. Hopefully that gets a little bit more strength because it did find that to be a really good support line going back to mid-April all the way through mid-May. But looking at this chart, this seems more of a breakdown candidate as opposed to something that I would want to be bullish on. So I'm curious to find out, what was the trade that this individual or this institution implemented?
Yeah, so this one it does look a little tentative, I admit. And then you could, on the plus side, if you were bullish, you could say, hey, it looks like it's finding support at the 50-day there. By the way, the 200's up here. So, Jeffrey, that's probably not a good sign to have the 50 this much below the 200-day, right?
That's also not a bullish signal.
Okay. And no offense to Cedar Fair. If we have any Cedar Fair employees on the line or anything like that, we are just looking at it from a technical perspective. Okay, what they did, they went out to the July 17th expiration. There's no earnings here, but they took the 30 strike and they purchased 2,000 of the 30 calls, and then they sold double, that's the call front spread, of the 35s in order to reduce that debit. So they ended up paying net 95-cent debit on this particular trade. So the 2,000 contracts cost them $2.15 a pop, and then the 35 call for 60 cents, they sold double that in order to reduce the cost, net 95 cents. So looks like they're looking for this stock to hopefully find support at that 50-day and gravitate up towards that 35 level. That would be the ideal situation if at expiration this guy closed at $35. Is this a strategy that you ever entertain here, Jeffrey?
I do it a little bit different. I'll do the long call, and then I'll sell going out like a calendar spread, if you will, on different expiration days. But I do see exactly where they're coming from, and I think if that's where they've done the most research on and where they're most confident, then they could stand to make a pretty decent penny over, what is it, a 1 week period?
Yeah, basically, let's see, almost 3 weeks. We're looking at July 17th. Yeah, roughly 3 weeks. So
Okay.
they kind of want this guy to levitate a little bit here over the next 3 weeks. But
Yeah,
yeah,
maybe
you're
it's
right.
somebody that's
It's a
focused in on
5
the
to
theme
1.
park space. Mm-hmm.
Yeah, I know. And that's the thing. It's I think there was a report out that Disney there was a petition being gathered to prevent Disney from opening in Florida because of the uptick we've seen in COVID. So yeah, you would think for Six Flags and those kind of places be tough, over the next couple of weeks as we see these cases rise. So yeah, that sounds a little bit iffy, but I'll just say, guys, if you've ever looked at a strategy like this, keep in mind, since this block trader is short double the 35 calls, you're going to have a margin requirement. You could say net, he's short 2,000 of these 35 calls where that margin requirement would come in. He's covered by the other 2,000 because he's long those 30 calls there. So it's not, I like the idea of reducing the cost, but, if you have free capital that, the margin requirement doesn't tie you up too much, it can be okay. But keep in mind, on the other side of this, if the stock were to really take off, then that's where you can incur losses. And of course, if it closes below that 30 strike, then it's just like a bull call spread that you could lose the full amount invested there.
Yep.
Okay, we are running tight on time. Let me just go real quick to a couple of biotechs because they have been holding up. Let's just take a look at. I just wanted to see what biotechs are doing because Jeffrey, they did break out to all-time highs this week.
Yeah.
Did this hit your radar, the biotechs?
It's obviously something that I have to pay attention to because of what's happening with COVID. But everything that I've been reading doesn't seem to match what we're seeing on a chart perspective. The mass psychology is that things are getting bullish, and from what I've been reading, that's absolutely not the case. They don't have anybody that says, okay, we're ready to start a new trial, we're ready to give this a go, we're ready to put this in front of the for the drug stages. I'm forgetting right now is it the FDA, the Food and Drug Administration? It just, boy, I just really have a hard time believing in this pull up. So that gives me a little bit of pause, buddy. Not to be long-winded, but what are your thoughts?
Yeah, no, yeah, from a technical perspective, I know a lot of that is kind of the push up here. So yeah, that makes me a little bit concerned. From a technical perspective, if I were to draw, resistance, I think we went back here on this XBI or on the IBB. I think that level around 105 was resistance, or maybe it's XBI. I think it's XBI. If it were to pull back here from a trading perspective and do a check back down to roughly 105, I might take a stab or something like that. Perspective. That's it. Not, and I understand what you're saying. He's there, but let me just say really quick, Alchemies. So there was a block trader that went out 50 times the average daily volume. They went out to February 2021. There were a couple large blocks that were bought for $1.87 and $1.84 on the February 25 strike. Looks like we had some more activity there as well too. Whoops, these are on the puts. So this one, I wonder if someone sold a put there that came up later as a risk reversal. But there was these were definitely buys here on the 25 strike for Alchemies. And then the other pharmaceuticals, 22 times daily average volume. There was a 5,000 contract block that was purchased out here on the October 70 call. I find it interesting just because it's biotech. Biotech has actually been a relative outperformer. So just bringing that to your guys' attention. Okay, Mr. Avalos, we got a late start and we're getting a late finish, but thanks so much for joining me today. I hope you stay safe out there. My man.
Likewise, my friend. You stay safe, be safe, but have fun too along the way. Enjoy yourself while you're inside. Think of a
Yeah.
game that keeps your mind active and your spirits high.
Great. All right. Love that advice. Thanks so much. And guys, stick around. We've got Behavioral Finance, How Emotions Impact Financial Decisions with Robert Kamek and Michael Schmidt. So join us at the top of the hour for that. Thanks so much for joining us today. We'll be back next week. We've got a